Principle 6, access owner's liquidity. This has got to be one of the most exciting principles of them all, because ultimately, if you're trying to create wealth and freedom from your business, you've got to access the liquidity that you're building up within it. And we'll talk about all the ways you can do that. But when you think about it, when do entrepreneurs typically get paid? When do they typically get in a position where they can actually get liquidity for what they've built? When they exit or when they sell their shares. And I'm going to go through minority investments, majority investments, sale of 100%. But ultimately, there's a power to creating passive income through your business asset. A lot of entrepreneurs who create wealth through business assets create their business in a form that can continue to pay them year in and year out. And ultimately, what this principle talks about is that if this is your business's balance sheet, and there's money here on your business's balance sheet, why is it there? Because you've reinvested for growth. It's caught up in working capital. It's caught up in inventory. It's caught up in a whole bunch of elements here. How do you move that to your personal balance sheet? Every family, every household has their own personal balance sheet. But how do you move this money from here to here in a tax efficient manner without selling your equity and violating principle 1? How does this happen? Well, there's a lot of ways it can happen, but the problem is most entrepreneurs don't know about them. So what I talk about here in principle 6, access owner's liquidity, is all the ways that you can actually get liquidity for what you've built, move your assets from one balance sheet to another in a tax efficient manner. That's a win for you, the owner, a win for the entrepreneurs and the business, a win for everybody. What are the ways you can do this? How can you move it from one balance sheet to another? First of all, let's just talk about some of the ways that traditionally entrepreneurs get liquidity for what they've built. One is they seek out a minority investor, or they sell a minority of their shares. Let's say you own 100% of your company and you've built something nice and you want to get some money for it. What a lot of entrepreneurs do is sell a piece of their business. Let's say you sell 20% of your equity in a business and you get liquidity for that 20%. Well, that just violated principle 1. You just brought somebody else into the henhouse. You got another person at the table. Even though they own a minority share, that doesn't necessarily mean they don't have a say. They probably have some voting rights. If they're a sophisticated investor, they probably added in some veto rights, some things they have to oversee or approve upon. You just made your life a lot more complicated. If you truly believe in your business and truly believe what you're doing, why would you ever do this? Not highly recommended. Even worse is when you sell a majority stake in your company. Countless entrepreneurs have sold a majority in their business. They retain 40 or 30% or whatever it may be, but they lost complete control of their business. Their culture completely changes. The people they care about get mistreated. The business doesn't actually build what it aspired to build when you were leading it. You sold a majority because you wanted to get your chips off the table. You wanted to kind of cash in a little bit. But if you truly believe in what you're doing, why would you ever do that? It doesn't make a lot of sense. And the third way is they sell 100%. They get out. Now, I'll tell you right now, a lot of entrepreneurs will tell you this as well. Those who have sold their businesses, they sold the minority, they sold the majority, or they've had experience in these areas. If you're going to sell anything, just sell and get out. If you're done, just get out. But why does that happen? Why do entrepreneurs sell and get out if they truly love their business, if they truly want to keep building it? But why do they do that? Because they want to monetize what they've built. They're scared that if they don't monetize this right now, they're not going to be able to ultimately exercise that, or they want to enjoy the fruits of what they've built today. Or maybe worse yet, maybe they're tired. Maybe they haven't built a culture of entrepreneurship in their business and they're the chief cook and bottle washer doing everything in their business. They have to sell and get out. Otherwise, they have to work in the business all the time and can't generate the passive income they're looking for. If you implement principles 1 through 5 properly, you should be able to create a business asset that can generate liquidity, generate passive income for you without you being there every day. But if you can't, maybe selling it and getting 100% out is the only thing to do. Now, before you consider any of these, or what I'm going to share with you in other opportunities to access owner's liquidity, you must have your protectors and advisors around you. Professional small business, medium-sized business CPAs that are experienced in this area, legal guidance, wealth advisors and guidance. You've got to have mentors and advisors around you to recommend all the different tools and resources that you can use. Let's walk through some examples of how partners can move their liquidity from one balance sheet to another. Let's go through example 1, which is distributions, okay? So think about this. One way to move money from one balance sheet to your personal balance sheet is to do a distribution to partners. Well, if you're in that position, chances are this is a taxable event. So let's say you decide you're going to distribute $1 million to the partners. So that's going to go out of the business, $1 million. Well, chances are, whether it be the company or the individuals, will probably face around $400,000 of taxes from that distribution. In that particular scenario, the owners get $600,000, the government gets $400K, and the business just lost $1 million on their balance sheets. The business balance sheet lost $1 million, $400,000 went to Uncle Sam or taxes, and the owners got $600,000. The business was weakened by $1 million, and the owners got $600K. That's one way to move money from one balance sheet to the other, but not really a good idea. You're basically taking money out of the business, and you're not able to compound and reinvest this money in your business and get the tax advantages of it, so you're not going to experience the compounding wealth opportunity. One opportunity to move balance sheet assets from your business balance sheet to your personal balance sheet is to create a safe harbor 401k cash balance plan. There are tremendous benefits with a safe harbor 401k cash balance plan. Okay, first off, by the definition of safe harbor, what that means is it satisfies the Employee Retirement Income Security Act. The way it satisfies that requirement, the ERSA requirement, is everybody gets a 3% match. A lot of companies, if you participate, they'll match what you participate up to a certain amount. In a safe harbor plan, everybody gets it. Whether you participate in the 401k plan or not, everybody gets 3% of their income in their retirement plan. So first off, it's a win for the employees. It works. But the second part of it is the cash balance. What that really means is it combines the defined benefit plan with a defined compensation plan. And what that means is by doing some profit sharing over here, if your company has some profits, you can actually put more money into your employees' 401k plan. And it becomes a profit sharing part of this plan. But here's the twist. You are also an employee of that company. As an owner, I think the limit here in 2023 is around $23,000 or so that you can put in your 401k. But by executing a safe harbor 401k cash balance plan, you can put up to 10 times that amount in your personal 401k plan as an owner, while also giving your employees an automatic 3% match and profit sharing in their 401k plans. It's a win-win-win for everybody, and I cover that more deeply in this book. And in the $100 million workbook, we provide some articles as well. You can go do research on this so you can discuss with your CPA. But if you think about it from this perspective, your business has $1 million of taxable net income. And what you do is you say, you know what? We're going to put some money into the 401k plan. So within all of this, you put $450,000 into the profit sharing plan for your employees. Well, now your company's taxable income is $550,000. This $450K went to you, the owners, and the employees' retirement plan. You're moving it to personal balance sheets from the company. The taxable income just went down to around $550,000. This is going to provide a tax savings ultimately to you and the business. The business has $450K that's going out this way, and the tax benefits probably equal around $180,000 of tax savings by this move. 40% of the money that you're moving over here versus going to tax. You have 40% of this going to tax, around $220K is going to go to tax. So compared to the prior scenario, your tax that's going to the government is less. You're putting more money on you and your company's balance sheet, and it's a win for everybody involved. This is a way to tax efficiently move money from balance sheet A, your business, to balance sheet B, your personal balance sheet. In Principle 5, Protect the House, I talked about a captive insurance program and how that can protect and help your business against these extraordinary risks that exist. But there's also another benefit to a captive insurance program. The benefit is when you set up a captive insurance program, what you're ultimately doing is you're setting up an entity to which you and your owners own, which is an insurance company. You're basically self-insuring your company against these extraordinary coverages. Coverages like loss of key employee, loss of key customer, cyber threat, workplace violence, defense litigation costs, a whole bunch of other coverages you just cannot get by going to your commercial insurance broker. Those exist in your captive insurance policy that you can self-insure. In the exact same example I've been giving, if your business has $1 million of taxable income, that's how much you'd have to pay if you distributed that all out, but you decided to do a captive program. And so you decide, I'm going to create a $250,000 policy That's going to go to the captive company, which is your company, by the way. So the money's going to another company's balance sheet to which you own. Your taxable income is now $750K versus $1 million. You've just moved $250,000 of taxable income to another balance sheet, which will be taxed at capital gains rates versus in this scenario is going to be taxed at ordinary income rates. Something to talk to your accountant about. But in this particular example, you basically now have reduced your taxable liability. You're going to pay tax on this, as you know, and you'll create another savings here from the tax you're not paying on this, which is around $100,000 savings in tax that you're actually moving this money from your business's balance sheet to your captive balance sheet. So this is a net where ultimately you have the benefit of the insurance coverages and you're reducing your tax liability by moving the money to another company's balance sheet, which will be taxed at lower interest rates. A phenomenal program to look at. Another way I talk about in the book, The $100 Million Journey, on how to access your owner's liquidity in a tax-efficient manner is by setting up a series LLC holding company. When you start generating net income and taxable net income from your primary business, again, as we talked about before, you can distribute that and pay your taxes and move money to your balance sheet, but it's not very efficient. And if you think about business A, which maybe is making $1 million, another way to basically have that money keep working for you in a compounding manner, let's say it's business A, is to create business B. And by investing in business B through a series holding company, you get the tax benefits and the legal protections of another business. And a lot of times, let's say you invest some money here, and you say, I'm going to go acquire another business or invest in another business, and we're going to put $300,000 to invest in that particular business. You're reducing your taxable income, and a lot of times that business could have accelerated depreciation as well, where you can get a lot more benefit than this. But your taxable income comes down if you invest $300,000 into a new business, if you're starting up a new business segment or whatever it may be within your own business. But by creating a series LLC holding company, ultimately what you're doing is you're kind of setting up this holding company here, and you have your business A, and you have your business B, and maybe eventually you'll have your business C and D and such. But all these businesses can all get tax benefits separately and all have the legal protections associated with them. Let me provide a summary example on how these opportunities can work for you. And I gave you the example this whole time about a business making $1 million. Well, think about it this way. If your business made $1 million and you decided to do a safe harbor 401k cash balance plan and put $450,000 towards that safe harbor 401k cash balance, and you decided to do a captive policy, and in your captive policy you decided to do $250,000 towards your captive to get all the additional extraordinary coverages that you need and start your own captive insurance company to self-fund your captive policy. And then you decided to start a new business which required an investment of your cash and expertise and such of $300,000 for starting a new co. Well, if you look at it from this perspective, how much taxable income did your business have? Your business had zero taxable income. What you did is you reinvested in your team and yourself. You reinvested in a captive insurance company and protected your business. And you started a new company, which hypothetically will have new employees and foster growth as well. Guess what? That's what the government wants you to do. They want you to reinvest your earnings to further grow business, which will further help people grow, which will help them spend more money, which will collect more taxes ultimately. This is absolutely one way to move your liquidity from balance sheet A to balance sheet B, because in this scenario, in the 401k program, you just provided in your 401k plan 10 times the amount you can provide regularly. You've funded your captive insurance company, which you own, so this $250,000 went to your captive insurance policy, and pending there's no major claims, you're actually building another business asset, and you're diversifying into a new business. By doing this, you're able to access your owner's liquidity, but also further prepare yourself to move from CEO to chairperson, which is principle number 7.